Good afternoon, and thank you for joining us for a video update of our thoughts on the economy and investment markets around the world. Today is Thursday, May 19th. My name is Joe Terril. I'm president of Terril & Company, headquartered in St. Louis, Missouri, with approximately $660 million of discretionary assets under advisement. Brian Curtis, as always, will be helping me with our thoughts. And Brian, if you're ready, maybe let's start discussing what's going on in economic news around the world. We'll go into investment outlooks after that and then summarize it. There's plenty of economic news to talk about around the world, and particularly in the United States. Let me start with retail sales. Recent retail sales figures in the United States have been somewhat disappointing for the department stores, the home retailers, etc. We do not believe this is the consumer tapped out. We don't believe this is going to lead to a slowing of the United States economy. The American consumer, as measured by total debt, credit card debt, mortgage debt, automobile debt, earnings, wages, employment, the consumer's never been in better shape in the United States than what they are in currently. We subscribe to the theory that just as in the past 2 years, the United States economy will pick up later in the year, and we're not entirely suspicious of why the statisticians seem to get this wrong in the first part of the year for the last two. So the 0.8% growth that are the early indications for the first quarter of 2016, we think by the fall of the year, the economy in the United States will be on a run rate of maybe 2.5%, maybe even approaching 3% real GDP growth. We are also a little more bullish on Europe than what others seem to be. We see early indications that the consumer in Europe is finally beginning to spend. We see auto sales and some other things in Europe picking up. So we find ourselves overall, if you throw in China, overall a little more bullish on the entire world economy. There seems to be a lot of undue pessimism that prevails right now around financial markets around the world concerning the world economy. But we see plenty of things that lead us to believe the world economy is beginning to improve and will continue to improve. The second thing we need to talk about, of course, is interest rates. We have positioned ourselves in the last couple of years in portfolios for higher interest rates, and we are beginning to be vindicated by this. Not only has our floating rate bond paper really begun to perform well, with numerous financial institutions calling away paper at face value that we bought at a substantial discount to face value. As interest rates go higher, our income will go higher with it. Yesterday, the Fed made pretty big news talking about perhaps increasing interest rates at the June meeting. We think this will happen. We also believe the Fed will increase interest rates 2 to 3 more times before the end of the year, mainly because inflation figures are going to pick up in the United States and around the world. The idea that we could maintain inflation at 0 to 0.5% is now behind us. Recent inflation figures are running closer to 2.5 to 3%. This will be the driving force of why the Fed will continue to normalize interest rates over the next 12 months. The normalization that we look for is perhaps 2% on a Fed funds rate, with a 10-year government bond trading back closer to perhaps 3%. So interest rates higher is one of the things that we look for. We do not see this causing a major problem in the world economy. With interest rates at 0 going back to 2%, we don't see this preventing anyone from making a major decision about a purchase, or businesses making a major decision about CapEx spending. One of the other issues is perhaps Britain voting to leave the European Union. We don't think that will happen. We think the vote will be no, stay in the European Union. But if we're wrong and they do vote to leave the Union, it's not going to hurt the world economy as much as it'll hurt Great Britain. And we don't see a major problem for the world economy predicated upon that. It'll actually cost Great Britain economy, exports, etc., that'll be picked up by other countries. So we continue to believe the world economy is going to do better. We look for higher inflation, higher interest rates, but not enough that it's going to cause major ramifications with world economies. And with that, Brian, let's switch and start talking perhaps about investments. In the world of investments, markets basically have gone nowhere in the last 18 months. The fundamentals call for prices to be at these levels, but people are having trouble seeing, well, what could make them go any higher. On the other hand, markets seem to have severe and sharp pullbacks when people become concerned about A, higher interest rates, B, economic slowdown in China, potential election in the United States, Britain's exit from the European Union. But ultimately, markets turn around and come back up to where they've been because there's nowhere else for people to go with money. If you look around the world at the incredible low level of interest rates, or even in many countries, the negative interest rates that we see, all of a sudden a 3% dividend yield on a well-known stock doesn't look so bad. So in general, we look for this to continue. We look for stocks to be volatile, and this includes foreign markets as well as ours, where they're up and down based on the news of the moment. At the end of the day, they probably will be within 10% of where they started, one way or the other. So our strategy in this environment is trying to buy what we believe are good companies with good potential on these buybacks. If they raise prices on the stocks to what we think is back to a decent level, we'll sell them, take our profit, and go on down the road. If not, and we get stuck with a good company paying a good dividend, we'll accept that also. So we, within the world of stocks, as mentioned earlier about being vindicated, we've continued to be overweighted the major bank stocks, and they've begun to perform now based upon higher interest rates. And we think this will continue. We continue to like our bank stocks. In June, when the CCAR announcements are made, we think this will be another positive for the major banks. They are generating billions in capital, and there's nowhere to go with it other than return it to shareholders. And as they get permission to return more and more cash to shareholders, we think the stocks will be excellent performers. Certainly, they've outperformed recently, and we believe this is going to continue. In the interest rate structure, we're holding our floating rate paper. It's now a very good performer. We do think we're going to see higher interest rates, therefore we would get coupon increases in our income. And our thesis that we may get icing on the cake because a lot of these institutions will retire this paper early is also beginning to happen. Two recent names that we owned were Union Bank of Switzerland as well as HSBC, both retiring issues at face value that we had bought at sizable discounts. So higher interest rates, higher inflation, not a lot of change in equity prices, and gold, if anything, slightly to the downside. We're bullish on oil. The balance between supply and demand seems to be balancing, and if anything, the demand is beginning to surprise a little bit to the upside as we see countries like India using significant more petroleum than perhaps what people estimated a few years ago. So Brian, with that, let's close it up, and we'll be back maybe in 3 weeks to a month with an updated comment. And we also post written comments for those that would like to read them. Thank you. Thank you for joining us today, May 19th, 2016. I'm Joe Terril, President of Terril & Company, independent wealth managers in St. Louis, Missouri. And helping me, as always, with the camera work has been Brian Curtis. Brian, thank you. And we will be back with updates to our thoughts in 3 weeks to a month. Have a nice day.